Very good morning to all joining us today on for the webinar on this Saturday. My name is Sudarshan, and I will be taking you through today's webinar. Over the past month and a half, quite a few events have happened, some shaky and some indicating stability in the world economy. We will be looking at some of those parameters today. So this is the agenda for today's webinar. We will start with the world economy, where we will look at the Indian economy and how the world and the Indian economy affect your finances, and then we look at how to arrive at the investment strategy. To start off with, let's start with the European Union and the United Kingdom. The EU and UA economies have been performing quite well. This primarily is fueled by the uh, ultra low interest rates maintained by the European Central Bank. So as can be seen in the right side of your screen, the PMI indicators for September across all indicators of services, manufacturing, and composite are all very strongly positive. They are reaching new highs. But that said, on the left side of your screen, if you look at the inflation of the European Union, it's at 1.5%. And as discussed in the previous webinars, the European Central Bank would want the inflation to be at 2%, at a stable 2%. The 1.5% suggests that consumption activity is not yet picking up, but it eventually will. The unemployment rates in both the European Union and the United Kingdom are significantly low. They're low since the Great Recession of 2007. But that said, what must be considered is that the current boost in the economic activity in the European Union is primarily due to the low interest regime maintained by the European Central Bank. Although these indicators suggest that the European Union is doing quite well, there are a few rocky roads up ahead, mainly in the form of one of its key members, Spain. A separatist movement is taking place in Spain, where we have Catalonia, a region currently in Spain, seeking independence from Spain altogether. With Catalonia becoming an independent state of its own, there is a prospectively negative impact on the European Union itself, because that will mean a higher instability in the European Union altogether. But it's not just Spain that might be causing the problem. Recently, there were elections conducted in Germany, and as expected, Angela Merkel will be continuing her term as the leader of Germany for a third consecutive term. But on closer inspection of the results, right-wing populism has also gained a little bit in Germany. A newly founded party called Alternative for Germany had gained seats in the German parliament. But uh, that wasn't enough to start the formation of the new government. But looking into it a bit more deeper, right-wing populism is the biggest threat to the European Union altogether. With small gains made in Germany itself, and with Italy going to elections shortly, a lot of parties in Italy which favor exit from European Union are gaining. So that potentially means that Italy might also be heading for an exit from the European Union, just like Britain. All of these factors put together contributed to the decline in the value of euro compared to the US dollar. But that said, German bonds have actually increased because with the return of Angela Merkel as the leader of Germany, there will continue to be prosperous and stable growth in the region. Moving on to an economy much closer to home, Japan. Japanese economy has also been doing well. All indicators, as measured by the PMI, suggest that growth has been stable and it's positive. And inflation, which is the biggest problem that Japan is facing, is consecutively positive for most part of this year. Wage has also been positive. Japan too is embroiled in a sort of a political situation, though, just like the European Union. Prime Minister Shinzo Abe had recently dissolved the lower house of the parliament. Something similar that had happened to the United Kingdom. In the United Kingdom, about 2 months ago, Prime Minister Theresa May had dissolved the parliament so that she could have hold flash elections and hopefully gain more ground in the parliament to pass more reforms. Unfortunately, she wasn't able to gain the necessary majority in the parliament. And Japan is also heading for something similar. Prime Minister Abe's uh, party currently holds the two-third majority, but they want a few more uh, members in the parliament in their favor, which is why they had favored for a dissolving of the parliament and a flash election. But just like the United Kingdom, Japan too might face a sort of a situation where Prime Minister Abe may not get his majority, but in fact may lose some of his majority. The Bank of Japan continues to maintain negative interest rates. It signals that as seen on the screen, the Bank of Japan expects that the economy of Japan will perform well this year. But it is not confident of gaining the inflation rate of 2%, just like the European Central Bank. Moving on to Japan's the largest economy in the world, USA. The United States, as indicators suggest, is also doing very, very well, as can be seen on the right side of the screen. But on the left side, on the first panel, if you see, the inflation is at 1.7%. And the third panel, if you see, the jobs were not added. In fact, jobs were lost in the previous month. This is surprising considering how for over more than a year, jobs have been consistently added to the United States. But last month was the first time they actually lost jobs. So there are a few worrying indicators in the United States. There is a job loss, the inflation is also low, and which is why the last policy review conducted by the Federal Reserve, they did not change the interest rates. They left the interest rates unchanged at 1.25 to 1.5%. But the Federal Reserve believes that the loss in jobs is primarily because of uh, consecutive hurricanes hitting them. We had Hurricane Harvey, then Hurricane Irma, and now Hurricane Maria. All three of which had battered the eastern coast of the United States, which is why they believe that there was a loss in jobs. They believe it is more of a short-term or immediate-term effect rather than a long-term effect. The Federal Reserve believes the U.S. economy is going to do well. We have so until now the Federal Reserve was primarily fueling the growth in the United States using debt, but now they have reconsidered, and now they will be cutting down their uh, balance sheet. Currently, it stands about $4.5 trillion. The Federal Reserve will slowly be tapering off this debt at a rate of about $10 billion per month. All of these are uh, indicators that the US economy is only facing a temporary blip in its economic performance and that it is actually growing robustly. And thirdly, next we move on to the Asia Pacific region. Asia Pacific is Asia Pacific currently is the biggest emerging region in terms of economic performance. Primarily, it is led by China, the world's second largest economy. Indicators in China, as measured by PMI, suggest once again that the Chinese economy is doing well, and Southeast Asian economies, which are dependent entirely on China, is also doing well. But that said, there once again lies a few more factors that are underneath all the positive indicators, which primarily is the source of funds. China has been fueling its growth using debt, and it's been mounting more and more debt, almost to the point of about 250% of its GDP. That's about 3.5 times the GDP itself. And that becomes something very difficult to manage for China. It is quite unsustainable, and which is why Standard and Poor cut China's credit rating from AA to A plus. They foresee a possibility of government bond default soon, as did Fitch ratings as well. Now, when China faces a downgrade, the whole of Asia Pacific region, including India, faces a loss in investments. There is potential outflow of cash, which also, which, as you may have followed the news, explains why the rupee has been declining. And for those who have been following the markets, would have also noticed that there were frequent corrections in September owing to the fact of China's downgrading in its credit ratings. With that said, the People's Bank of China had recently scrapped some of the currency policies, mainly the currency forwarding policy maintained by the Bank of China. Because of the scrapping of this policy, Chinese investors can now buy dollars a lot more easily and sell yuan a lot more cheaper. What that basically means is that yuan will become cheaper. And the yuan did become cheaper. However, it is still up by 6.5% this entire year. A lot of more reforms are needed in China if it has to manage to stabilize its growth. Currently, it is fueled primarily by debt. And as the debt grows, the ability to repay the debt becomes a much bigger problem. And if China sneezes, the whole of Asia Pacific catches a cold. Now, China is the world's biggest importer of commodities, and Latin America depends entirely on commodities. With the Chinese economy performing well, naturally the Latin American economies also perform well. Brazil, which was in a recession until the beginning of this year, has managed to clock in positive growth in all aspects of its PMI, be it manufacturing or services or the composite. The inflation in Brazil was as high as about 12% last year, and currently it is the inflation in Brazil is at its lowest in almost 18 years. This primarily is due to the intervention of the Central Bank of Brazil and by President Michel Temer. Brazil had lost almost 8% of its GDP since 2014, but this year it seems to be regaining some of its lost GDP. And Brazil, similar to China, is the biggest economy of its region. So if the economy of Brazil does not perform well, neither does the economy of some of its neighbors. So when Brazil does perform well, as shown by the indicators to the right, it would mean that the economy of Latin America as a whole is recovering. Looking at all of the economic numbers from the countries across the world, be it Japan, USA, Latin America, or European Union and China, all suggest that the world is actually recovering. And some of the countries are tapering off their debt. So all of this suggests that the world trade is picking up despite call for protectionism and consumption activity is picking up despite reduced trade. We will now look at commodities, which is the biggest indicator of how the economies of the world are going to perform. If you look at oil, oil had fallen uh, through the month of August. It had hit a low towards the end of August, but has been rallying since then. The reason being, oil markets are now seeing growth in demand. So even though there were calls for clean energy, uh, predictions of electric vehicle taking over the market by the end of this decade, oil is still an indispensable commodity until we get to that phase. With the economy of Europe and China picking up, demand has been increasing from these regions. So the European Union and the emerging economies have pushed for a surge in the demand. And Saudi Arabia, which currently is dependent entirely on oil for its economic support, has begun reforms to rebalance its economy to a more uh, balanced economy with less dependency on oil. So recently, Saudi Arabia had cut down its oil production, its biggest cut in many years. With this reduction in oil production, despite the growing demand, oil prices are set to reach heights. So on 25th September, for example, oil prices reached $52 per barrel after the OPEC, which is the oil Organization of Petroleum Exporting Countries, a consortium of countries that export oil. In November last year, they had decided to cut down oil production to bring up the prices, and that has taken effect, and which is why the oil prices reached $52, which is a high of almost 2 years. And uh, to further reduce the production, Saudi Arabia, which is the biggest exporter of oil in OPEC, has reduced its oil production from October 10th onwards. So we can expect oil prices to rise further. Oil is one commodity which indicates how the demand will grow, but there is a commodity which determines the market sentiment itself, which is gold. As can be seen in the graph on the left side, uh, gold prices have rallied through August, reaching a peak in mid-September. How this can be interpreted is that investors were more wary of risk, escalating risks at that time, and from September to October, September, mid-October, gold prices had declined, which indicates that the risk factors had declined in the entire world. The primary risk factors that drove the prices of gold came in mostly from the United States. From the beginning of August to September, U.S. and North Korea tensions had escalated. There were potential calls for armed conflict between the two countries. All of these had reached a sort of an uncertainty in the world, especially in the United States. Now, when there is uncertainty or whenever there's volatility in the world, gold becomes a preferred instrument. Now, with the escalating tensions, there were increased uncertainty, which in turn led gold prices to breach the $1340 mark in 6th September. Additionally, the United States government was facing a potential shutdown when President Trump threatened to shut down the Congress if they did not support his proposed wall with Mexico. And when President Trump had agreed to a deal proposed by the Democrats to raise the debt ceiling, about $15 billion, the shutdown was averted. The $50 billion is meant to support the relief measures in due to the hurricanes Harvey and Irma, which we had discussed previously in the US section. But with the threat of government shutdown averted, investors were back to investing in the US, which is why we can see mid-September onwards, the prices of gold declined. But that said, when reports of jobs being lost by the United States came up in early October, gold prices once again increased, as can be seen. So, primarily, what will be driving gold prices going forward is going to be news from the United States, which potentially is which is at the moment quite a bit unpredictable. Looking at all of this, we come to India. PMI indicators for the month of September, that is the manufacturing service activity, they all suggest that India is back to growth. Excuse me. Am I audible? Right. The PMI indicators, as suggested by the PMI indicators for manufacturing services, all indicate positive growth for the month of September. If you look at the PMI for just the previous month, in August, you see that the services activity had declined by 47.5 and had a reading of 47.5. And any reading below 50 indicates a decline in activity. We also had a lot of expectations that the government of India, which had introduced the demonetization and the introduction of the GST bill hastily, had affected the Indian economic growth. Which is why the GDP for the previous quarter, that is the one which ended in June, stood at about only 5.7%. So India had lost the tag of the fastest growing major economy once again to China. Although there were calls for the government of India to introduce a sort of a fiscal stimulus to boost the economy, there also needs to be a few factors that need to be considered. For example, although without introduction of fiscal stimulus, we have seen economic activity picking up in the month of September, which suggests that the Indian economy is slowly adapting to the introduction of the GST and is shaking off effects of the demonetization. So while a fiscal stimulus is required to boost the growth of the economy, there also needs to be sort of a measure up to in which the fiscal stimulus should be maintained. Most of the economies, such as China and the United States, invest in infrastructure to boost economic activity, which is a similar activity which we will be expecting, provided the government does push for fiscal stimulus. Now, looking at inflation for India. Apologies for the technical glitch there. Yes, so as we were discussing, under the inflation for India is at about 3.36% as measured by Consumer Price Index. The RBI, which has adopted a policy of inflation targeting, would keep the inflation at about 4% plus or minus 2%. So the inflation is quite under control by the RBI standards. But as discussed in the previous section of commodities, Oil prices are set to grow, and with growing oil prices, India, uh, which which imports oil as one of its biggest as one of its most biggest imports as such, is set to pass on the cost of rising oil prices to its consumers, which in turn means that the oil prices, uh, the fuel prices are set to increase, and with increase in fuel prices, the transport costs are going to increase, which in turn means food prices are also going to increase. With such factors under consideration, we may not expect the RBI to change the interest rates in the next policy meeting. In the last policy meeting as well, they had left the policy rates unchanged at 6.0%. The reverse repo rate still remains at 5.75%, and the MSF stands at 6.25%, which basically means RBI is continuing to maintain its status quo. Now, looking at all of these, we will look at how the world economy and the policies in India are going to affect the personal finances. So, as we had discussed, the oil prices are going to be the biggest problem for the Indian economy. With oil prices rising, fuel prices in India are going to rise. With fuel prices rising, we expect food prices to rise. So there will be, in the short term, uh, an increased expenditure in the way for your transportation and for your food needs. With the downgrading of the Chinese ratings, the Indian rupee will become a bit more weaker because India has seen a much more riskier economy compared to China. Now, with the weakening of the Indian rupee, we can expect exports to pick up. But however, importing goods will become much more costlier. The government of India had recently scrapped some of the excess duty on auto fuels. So there was a brief correction in the fuel prices by almost for 2 rupees per liter of petrol. But with the growing prices of fuel, this may only be a short-term effect. We will now look at how to invest in such a scenario. First, with the weakness in the Indian economy, there will be volatility. But that said, it could only be a brief effect because the Indian rupee is also weakening. With the weakening of the Indian rupee, exporting will become competitive. So we can actually see some of the IT and the pharmaceutical industries actually picking up, and these in turn will boost the will in turn boost the Indian markets. Over the long term, uh, the structural reforms which were introduced this year, they will bear fruit. So uh, there will be growth in the longer duration. So it is best to hold equity in this particular period rather than to trade for the short term due to the volatility. To overcome volatility, we would recommend that you invest in equity in the form of an SIP. With the slowing down of the Indian economy, the government will be expected to prop up its infrastructure spend. This basically means that the government of India can finance its funds only through one of two ways. They can either utilize a tax, or they will be issuing more bonds. Now, with the RBI not likely to increase interest rates, bonds will become bonds of medium to longer duration will become less attractive rather than pure longer duration. So it is best to hold bonds which span between the medium to long duration. With the global commodity prices rising, the RBI will remain more and more hawkish. For which particular reason, bonds of a medium duration will become more attractive than those of longer duration. So, it is best to have bond in a portfolio to avert the volatility that will be induced by equity. And preferably, these bonds should be between the medium to long duration. Political uncertainty exists across the world, as we have discussed. The European Union has elections in the form of in Italy. There is a potential independence of Catalonia from Spain. In Japan, we have the dissolving of parliament and potentially uh, uh, the flash elections, which are called in October 22nd, might result in a hung parliament. And unpredictability still comes from the United States. So, despite all of these, due to all of these factors, there will continue to be volatility in the world. And in such a situation, gold will become a preferred instrument for investors. And this in turn will lead to the rising of gold. So it will be best to hold gold as a hedge rather than a pure form of investment in a portfolio. So as a hedge, it should only be holding accounted for only 5 to 10% of your portfolio. With this, we reach the end of our webinar. Thank you so much for your participation. We are now open to questions. You will be required to type your questions in the Q&A tab by the side. Yeah, a question regarding Sensex. So, where do we see the market heading in long run now, for say 3 years? So, first of all, for us, Sensex, long run for us would be something that's a duration of over 7+ years. Sensex over say 3 years. Well, we expect the Sensex to rally over 3 years as such, because we see a lot of factors which are actually shaping the Indian economy and setting it up for the growth for the longer duration. We may not be able to exactly pinpoint where exactly that the Sensex will end up in 3 years. But that said, what we are very positive about is that we expect that the reforms that have taken place this year will have an effect over the next couple of years. So by 2020, we will actually expect the Sensex to be close to about 40,000 maybe, or maybe even more. Okay, we have a question regarding how downgrading of Chinese ratings will make Indian economy less attractive. So, well, from a global perspective, um foreign investors will invest in economies that show a lot of promise and growth. And secondly, if they are to invest, they will invest in economies that have a lot more, uh, that have a much better credit rating. Now, the Indian economy falls under the broad category of Asia Pacific investments. In Asia Pacific, in Asia Pacific, the biggest economy is China. So, as an investor, if you would look at it, you would see that the best place to invest in a particular region will be the largest economy, which is China. With when the Chinese economy is downgraded, that too from a level of AA to A+, that will actually mean that the whole region of what Asia Pacific is facing some sort of how do I say, a financial weakness. So we will actually see fewer funds flowing into regions of financial weakness, which is an effect of the downgrade of the largest economy of the region. I hope that answered the question. A question regarding review of bitcoins and what are view on currencies. Well, we we don't particularly recommend currencies as a form of investment per se, because, well, primarily our investment philosophy is just to stay invested and not trade on a daily basis. So when we look at we do not recommend particular equities per se for the same particular reason, because we believe that if you're going to invest, we're going to stay invested. Uh, but when it comes to bitcoins is it's a sort of a more slowly growing, slowly acceptable concept in India. But there are still regulations that govern the cryptocurrency sector, specifically from the RBI. Recently, as some of you may know, bitcoins bitcoins are corrected quite badly. So it is a bit of a volatile sector to be in, considering the fact that there are no other cryptocurrencies in this as big as a Bitcoin. So it becomes a sort of unhedged uh, fund of sorts, in which case you will probably be attracting a lot of risk. So uh, unless we understand what other factors are governing the growth of Bitcoin, we may not be able to take a stance on it. Regarding equity-based mutual funds, uh, for targeting 3+ growth year, would we advise large, mid, small, or diversified? Um, it depends entirely more on your risk profile primarily. Uh, on that particular regard, we would suggest that you talk to your financial planner, because they are in a they are in a much better position to advise you on that regard. But regarding the growth, we see large, mid, and small sectors all growing over the next 3 years. So there's sure to be returns over the next 3 years, so long as we stay invested. But regarding the allocation and where to invest in, it is best that you talk to your financial planner. Question regarding currencies. Um, we will be discussing currencies on a cursory overview, but we will not be recommending any currency per se as a form of investment. We have a sort of a We have a question regarding debt mutual funds. So, uh, debt mutual funds give about 7 to 9% return, whereas uh, is it possible to invest in alternative funds like PPF, SSY, debt mutual funds? Um, no, so when we recommend debt mutual funds, which cover all aspects of debt, it's primarily the source. That is, if you look at PPF and SSY, we all look. They primarily invest in a few government securities, whereas debt mutual funds as a whole will invest in a diversified set a diversified set. We will have corporate bonds as well as government securities. The problem with PPF and SSY is that their the rate of returns is uh, rather fixed. With the RBI lowering interest rates, having lowered interest rates over the past 1.5 years, um, the returns in the PPF have also declined, as have the SSY. And we don't foresee the RBI raising interest rates anytime shortly. So we don't really see much of a chance for the PPF and SSY to be raised in terms of returns. So in such a case, we would prefer that you diversify your source of debt, which means that you need to have exposure to both government uh, as well as corporate bonds, which is why we would recommend you stick to a debt mutual fund more than a PPF or an SSY for returns. Question regarding balance funds. In the short term of less than 3 years of investing, okay. Um, so the ArthaYantra portfolio is diversified in itself. So based on your risk profile, your investment ability, and your goal duration, we will provide a portfolio customized exclusively for you. And the funds which we recommend typically are balanced in itself. So if you are going to invest in a portfolio, we would recommend that you talk to your financial planner, because we do the balancing of the portfolio in terms of in terms of the balance of equity and debt, as well as commodities for hedging. regarding PPF and SSY. So if you look at the returns of the PPF and SSY over 1 year, about 1.5 years ago versus now, you can actually see that the returns of the PPF and SSY have actually been lowered. Plus, there is also primarily investing in PPF and SSY is usually for a form of longer-term savings. To And in some cases, it is to for investment for tax protection purposes. When we invest in PPF and SSY, we have a lock-in period, which is something that most of the debt mutual funds don't maintain. So if you are going to look for an investment for sake of debt protection, for sake of growth, then we would recommend that you invest in debt mutual funds. If you are looking to invest in a form for something that is for the sake of tax saving purposes, we would recommend that you look at uh, and other alternatives such as ELSS, for example. But on that particular regard, I am not quite in a position to comment what is the best tax saving instrument for you. Your financial planner, who will have much more information about you, will be in a much better position to comment on that. Okay, thank you so much.